We're now going to go through the definition of call options. Now, this may sound a little confusing at first, but I request you to just hang in there because it's going to become clear both from what we've discussed so far and what we are going to see as a real-world example. First of all, the buyer of a call option and the seller of a call option have very different rights and responsibilities. So this is very different from a stock. If you've ever bought a stock or sold a stock, the buyer and the seller have opposite but symmetrical positions. Whereas in the options market, the buyer and the seller, they are asymmetrical. And you'll understand what we mean as we get into these examples. Usually, options are explained using a bunch of jargon, and in my opinion, that's not doing it justice because you're still confused about what exactly we mean by rights and obligations and things like that. So let's briefly go through the formal definition, and then we are going to get to a real estate example which should absolutely make it clear what a call option is. But first, we have to get to the definitions, and so let's look at the definition of a call option. The buyer of a call option has the right to buy, in this case we're going to call it the stock, but it can be any underlying asset, at a certain price, by a certain time, and for this right they pay a premium. If you look at the olive speculator example, we didn't go into all the details, there was no premium or anything like that. However, the speculator had the right to buy the harvest of olives at a certain price, by a certain time, which was the season, and for this right, perhaps he paid a small premium. In our case, in the options market, this is how a call option buyer is defined. They have a right. So if they want to buy it, they can, but they don't have the obligation to buy it. Whereas the seller has an obligation. The seller has the obligation to sell the stock or the asset at a certain price, by a certain time, and for this obligation, they receive a premium. Buyers and sellers are on opposite sides of this contract, but their positions or their roles are asymmetrical. So which means one person has the right, the other person has the obligation, and so on and so forth. So let's harken back to our olive example. The speculator bought a call option, obviously, because he bought the right to buy the olive harvest at a certain price. We said it was $10, I believe. And then by a certain time, which was the harvest season, which was about 6 months. Whereas the farmers who are the sellers of this call option, they had the obligation to sell the olive harvest at a certain price, which was 10, by a certain time, which was the 6 months. So should be quite clear from this example itself what a call option is. However, if there's any doubt, we are going to go into the real estate example now, and then it'll be very, very clear what we are talking about. Let's say there is a piece of land, and we're going to call this our underlying asset. There's a buyer who likes this piece of land, and the seller wants $1 million for this piece of land. Now, the buyer needs some time. He needs to do some due diligence, financing perhaps, and so the buyer wants a hold for 60 days. And the buyer and the seller agree for a hold of 60 days, and in return for this contract, the premium that they agree is $25,000. So the buyer pays $25,000 to the seller, and in return, the price is locked for 60 days. And within 60 days, the buyer has the right to buy this land for $1 million. Seller keeps the $25,000 regardless of what the buyer decides to do. In simple terms, this is a call option. So this is the right to buy an asset, which is the land, for $1 million within a certain period of time, which is 60 days, and for a certain price, which is $1 million. And in return for this right, the buyer pays a premium of $25,000. This is exactly what a call option is. It's a very, very simple example of a call option. So at this point, we should introduce some option terminology. The buyer has the right to buy an asset at a strike price of $1 million, because that's the price where the contract between the buyer and the seller was made. So the strike price is the price at which the option contract is created between the buyer and the seller. And so in this case, it is $1 million, and that's the strike price. Buyer pays a premium of $25,000 for this right, as we said. And then the seller has the obligation to sell this land at $1 million, which is the strike price again. The expiry of this option is 60 days. The buyer loses the premium as soon as he gets into the contract. So whether he buys the land or not, he's lost that $25,000. The call option has been created on an underlying asset, which in this case is the land. Since the current price of the land is supposedly $1 million, and the strike price is also $1 million. Therefore, we can say that the strike price is at the fair value of what the current price of the land is, and therefore, this is called an at-the-money option. It's an at-the-money call option because the strike price of the contract is equal to or approximately equal to the current price of the underlying asset. So hopefully that's clear. This is an at-the-money option.